All right, let's talk about something every investor dreads, a market crash. But what if you could learn to see the warning signs before it happens? Well, today, that's exactly what we're going to do. We're breaking down 3 of the most reliable signals that trouble might be just around the corner. This isn't about having a crystal ball, not at all. It's about learning to read the evidence that's often hiding right in front of us. So, let's jump in. To really understand why this is so important, let's hop in a time machine back to the dot-com bubble. It's the year 2000. Microsoft looks like it can't be stopped, trading way up there around $50 a share. And then, poof, the bubble bursts. The stock gets sliced right in half, crashing all the way down to $25. It's a pretty brutal reminder that even the biggest, most solid companies can get taken down in a storm. Yeah, a 50% loss. That hurts. I mean, losing half of your money in a company you thought was a sure thing, that's a gut punch. And the emotional pain, that's only half the story. The real long-term damage, well, that comes down to pure, cold, hard math.
And this is where the math gets absolutely terrifying. Look, when your $50 stock drops to $25, you've lost 50%. Easy, right? But to get back to even, just to get back to where you started, you don't need a 50% gain. Your $25 stock has to double. You need a 100% return just to break even. That is a huge, steep mountain to climb, and it can throw your financial goals off track for years.
So to make sure we don't have to climb that mountain, we need a game plan. Here's our roadmap for today. First, we'll talk a bit more about the pain of a crash. Then, we're going to put on our detective hats and look for our 3 big clues: weakening fundamentals, charts that are turning ugly, and a crowd that's starting to panic. And then we'll wrap up with the most important part: how you can actually control your risk. So let's kick it off with section 1, the pain of a crash. Like we just saw, bouncing back from a 50% hit is a massive undertaking. And that kind of loss, it doesn't just hit your portfolio, it can steal years of your financial life, which is a really big deal, especially for getting closer to retirement. Okay, so from here on out, I want you to think of yourself as a financial detective. Now, your job isn't to stop the crime from happening. Market crashes are a part of life. No, your job is to find the clues, to see the evidence, and to protect your capital before the real damage is done. So let's go find our first clue. And that brings us right to sign number 1. The fundamentals are getting weak. Every crime has a motive, right? Well, this is the motive for a stock to crash. It's the real-world reason, the actual problem with the company or the economy that makes a stock's price fall. Something, somewhere is going wrong. Now, this fundamental weakness, it comes in 2 main flavors. You've got systemic risk. Think of this as a hurricane that threatens every single boat in the harbor. The 2008 financial crisis, that was a systemic crisis. The whole system was at risk. Then you have non-systemic risk. This is when there's just a problem with one specific boat. Think about a company having a massive product recall. Their stock gets hammered, but it doesn't necessarily sink their competitors. It's really, really important to know which kind of storm you're looking at. So, what are the big red flags for that whole market systemic risk? Well, number 1, you gotta watch the Federal Reserve. When they start raising interest rates, money gets more expensive for everyone. It's like tapping the brakes on the entire economy. Next, keep an eye on things like jobs reports and GDP. If those numbers start looking bad, it means the economic engine is starting to sputter. Things like crazy high inflation, a housing market taking a nosedive, or the end of easy money policies. These are all signs that the tide might be going out for everybody. Okay, now for the company-specific red flags. Is the company's cash flow starting to dry up? Are they taking on way too much debt? How about the return on equity, or ROE? That's basically a report card for the management. If that number is going down, it means they're not doing a good job of growing the business. But, oh man, here's a huge one. They cut the dividend. For a lot of companies, that dividend is sacred. Slashing it is basically a public announcement that they're in deep trouble. It's a major sign that a specific company is getting sick, even if the rest of the market feels just fine. Okay, so we've covered the motive. That was our first big sign. Now we move on to sign number 2, the chart's turn. You see, if the weak fundamentals tell us why a stock might crash, the charts can often give us a clue as to when it might happen. They're like a visual story of the fight between buyers and sellers. And I want to be super clear on this. Reading charts is not some kind of magic or hocus pocus. It's simple. A stock can only go up if more people are buying than selling, and it can only go down if more people are selling than buying. A price chart is just a minute-by-minute record of that battle. It's a map of investor psychology, showing you the footprints of where the money, especially the big institutional money, is going. So let's look at our first pattern. It's called the double top, and some traders have a nickname for it, M for murder, because it looks like a capital M. Here's the story it tells. The stock makes a big run up to a new high. Awesome. Then it pulls back a bit. Then the buyers try again, pushing the price right back up to that same high. But it can't break through. It fails. That is a huge sign. It means the buyers are exhausted, the sellers have taken control at that price, and anyone who bought on that second push-up is now trapped.
Next up, we have the head and shoulders. This is one of the most famous patterns out there. It shows an uptrend that's slowly falling apart. You get the left shoulder, which is a peak. Then you get the head, a final push to an even higher peak. But then the right shoulder is a much weaker attempt that can't even get back to the high of the head. It shows the buyers are just running out of gas. That line connecting the lows is called the neckline. And when the price breaks below that neckline, it's like the floor just collapsed. The uptrend is over.
And finally, we have the one that sounds the scariest, the death cross. This isn't about one bad day. It's about a major shift in the trend. All a moving average does is smooth out the price over time. The 50 days shows the medium-term trend, the 200 days shows the long-term trend. So a death cross happens when that shorter-term 50-day average crosses down below the long-term 200-day. It is a powerful signal. It's the chart mathematically telling you that the recent weakness is now officially in charge, and the bears have taken control. Okay, so we've talked about weak fundamentals and bearish charts. That leads us to our third and final sign. The crowd gets scared. This is all about psychology, because in the market, fear can absolutely become a self-fulfilling prophecy. The best way to measure fear in the market is to look at the VIX, which everyone calls the fear index. Think of it like a heart rate monitor for the market. Usually, when stocks are calm and going up, the VIX is low. When stocks start to fall, the VIX spikes. Fear is high. But here's the subtle warning sign you need to watch for. When the market is just kind of flat or even up a little, but you see the VIX starting to slowly creep higher, that's a huge tell. It means that under the surface, big money is quietly getting nervous and buying protection. Another way to see what's really going on is to follow the smart money. We're talking the giant funds and institutions. These guys are proactive. So when they start to get worried, they don't just dump everything at once. No, they quietly and strategically start moving their money out of the risky stuff and into safer places. And this shows us a really important concept called sector rotation. When times are good and everyone's confident, money flows into aggressive, fun sectors like tech. But when the big players get nervous, you'll see money flowing out of those high-growth sectors and into defensive, boring sectors. We're talking utilities, healthcare, the things people need no matter what. Seeing this shift is a clear signal that the smartest people in the room are battening down the hatches. Okay, we've done it. We've identified the 3 big warning signs. But just seeing the storm coming isn't enough, right? Now we have to talk about what you actually do. And this brings us to our final and most important section, controlling your risk. Or, as I like to call it, building your financial lifeboat. This is honestly the most critical question in this whole explainer. You can become the world's best detective. You can spot every single warning sign we've talked about, but if you don't have a plan for what to do with that information, it's completely worthless. So I'll ask you directly, what is your lifeboat? When it all comes down to it, you really have 2 choices. On one side, you've got passive hope. That's just buying, holding, and praying that things work out. When a crash comes, you have 0 control. You're just along for the ride. On the other side, you have an active plan. This means you have an exit strategy before things go bad. You know exactly what's going to make you sell to protect your money. With this approach, you are the one in control. I just love this quote. It sums up everything perfectly. You cannot control the market. You can't stop the iceberg from showing up. You have no say in whether the Titanic sinks. But what you can control is whether you decide to get on that ship in the first place without a lifeboat. Your exit strategy, that's your lifeboat. It's your choice to have one. So I'll leave it with this thought. We've walked through the clues, the weak fundamentals, the ugly charts, and the rising fear. Knowing these signs is the essential first step. But what comes next? Well, that's up to you. So the real question is your plan, is your lifeboat ready for the next storm? Because there will always be a next storm.